When the world's largest asset manager begins quietly shifting trillions of dollars, that isn't just a trade, it's a signal. According to BlackRock's 2025 Investment Institute Outlook, we are witnessing a fundamental recalculation of risk. The default safety of the American market is being challenged by a new logic of capital. This is the story of a global portfolio rotation that will define the next decade of finance. I'm Steve, this is Voice on Pages. Today, we decode the quiet rotation of the world's most powerful capital pool. For years, the US was the undisputed destination for global savings. But rising debt, extreme concentration, and shifting growth dynamics are forcing a strategic pivot. If you enjoy deep-dive financial analysis like this, consider subscribing to Voice on Pages. We are moving beyond the surface headlines to understand the structural shifts in global power. Capital doesn't have loyalty. It has logic. To understand the shift, you must understand the scale. BlackRock now manages over $11.6 trillion. As Larry Fink noted in his 2024 chairman's letter, this capital isn't just sitting still. It is responding to mega forces like digital labor, geopolitical fragmentation, and a transition to a low-carbon economy. These forces are rewriting the rules of global finance, making traditional, home-biased portfolios obsolete in a fragmented world. As Larry Fink noted in his 2024 chairman's letter, this capital isn't just sitting still, it is responding to mega-forces like digital labor, geopolitical fragmentation, and aging. It's vital to distinguish between capital flight and institutional rebalancing. BlackRock hasn't abandoned America. Instead, we see a 6 to 8 percentage point reduction in U.S. exposure across major multi-asset mandates. Think of it like a captain of a massive tanker. Hundreds of billions are moving away from U.S. public securities and into international and alternative assets. It's about stability, not exit. If you stack all your cargo on one side, the ship becomes vulnerable. This is a managed glacial rotation. It is the logic of weight distribution in a volatile world. The primary driver is the U.S. fiscal trajectory. Gross federal debt has crossed 124% of GDP. Persistent primary deficits, driven by structural imbalances between spending and revenue, have put the U.S. on a path that fiscal reports describe as unsustainable. For an institutional giant like BlackRock, the risk-free rate of treasuries now carries a policy risk premium that reflects the political difficulty of reform. This leads to the interest spiral. As debt grows and interest rates remain structurally higher, the cost of servicing that debt explodes. Net interest outlays reached approximately $880 billion in 2024, roughly 3% of GDP. This creates a crowd-out effect. For global allocators, this raises concerns about the long-term value of U.S. fixed-income assets and the stability of the dollar. Institutions are increasingly looking for shorter duration instruments or foreign sovereigns with cleaner balance sheets. The safe haven isn't as quiet as it used to be. Then, there is the concentration risk. The S&P 500 has become top-heavy. 7 companies represent approximately 30 to 36% of the index's market cap. This concentration is amplified by passive investing. Logic dictates we look at the mechanism. The concentration trap. The S&P 500 has become top-heavy. As trillions flow into S&P 500 index funds, the largest companies receive the most capital, regardless of valuation. This creates a feedback loop where winners win simply because they are already winning. For a giant like BlackRock, this isn't just success, it's a systemic vulnerability. Think of the S&P 500 like a massive tree. For years, the tree was lush and balanced. Today, only 7 branches carry almost all the weight. If a storm hits those specific branches, the entire tree is at risk of falling. This is why BlackRock is diversifying. If the engine of growth is only firing on 7 cylinders, what happens if the AI narrative stalls or regulation hits tech? Logic dictates you find more branches to lean on. The capital map. First, Japan. This is a structural re-rating decades in the making. The Tokyo Stock Exchange is pressuring companies to improve capital efficiency and price-to-book ratios. Cross-shareholdings, once the bedrock of Japanese corporate culture, have plummeted from 60% to approximately 25%, with more independent directors and a focus on shareholder returns. Japan is no longer a value trap. It is a diversification anchor for institutional capital. Next, India. As the world's most populous nation with a massive young middle class, India is the primary beneficiary of the friend-shoring trend. BlackRock is steering flows toward Indian manufacturing as companies diversify supply chains away from China. A sustained infrastructure push and high nominal GDP growth make India a structural play for long-term capital looking for growth that is demographically supported and politically aligned. BlackRock is steering flows toward Indian manufacturing as companies diversify supply chains away from China. Growth is demographically supported. And the Middle East. High hydrocarbon revenues are being recycled into global infrastructure and technology through massive sovereign wealth funds like the PIF and ADIA. BlackRock is partnering with these funds to co-invest in everything from data centers to renewable energy. The region is no longer just a source of oil, it is a central node in the new architecture of capital, where energy logic meets a desperate need for global infrastructure. The region is no longer just a source of oil, it is a central node in the new architecture of capital, where energy logic meets a desperate need for global infrastructure. Why are emerging markets attracting institutional focus now? It's a matter of valuation and growth spreads. International equities trade at more than a 40% discount to the S&P 500. Pause for a moment and think about this. If the world's largest asset manager is reducing concentration risk, what does that imply for the average portfolio? The logic of capital is undeniable. Why are emerging markets attracting such institutional focus now? It's a matter of valuation and growth spreads. International equities have traded at more than a 40% discount to the S&P 500. Pause for a moment and think about this. If the world's largest asset manager is reducing concentration risk, what does that imply for the average portfolio? When you combine low valuations with high demographic growth and cleaner government balance sheets, the logic of capital becomes undeniable. The world is becoming multipolar, and so are the returns. Orienting capital to private markets, this is the heart of the rotation. Private markets. Larry Fink's letters highlight an estimated $68 trillion infrastructure need by 2040. Governments, burdened by 98% public debt to GDP ratios, can no longer fund this through deficits. This financing gap is the greatest investment opportunity of our generation. We are witnessing the privatization of the world's physical foundations, from data centers to power grids. Why are banks missing this? Post-crisis regulations have limited bank balance sheet capacity for long-dated and higher-risk lending. Banks can no longer tie up capital for 20-year bridge projects or massive fiber optic rollouts. This regulatory constraint has created a vacuum. As banks pull back, institutional asset managers like BlackRock are stepping in to provide the long-term capital that a growing world requires. Private markets are the new bankers to the world. How private credit works. In a traditional system, a company goes to a bank for a loan. In the new system, they go directly to a fund. Private credit provides flexible, tailored financing outside the public bond markets. For institutional investors, this offers higher yields and contractual cash flows that public bonds once provided. The acquisitions of HPS Investment Partners and GIP position BlackRock to dominate this flow, intermediating the savings of millions directly into the world's infrastructure. This structural change is evolving the classic 60-40 portfolio into a 50-30-20 model, 50% stocks, 30% bonds, and 20% private markets. It is the democratization of the previously illiquid world, a shift in global financial leadership. History rhymes. In the late 19th century, British investors allocated massive sums to overseas railways even as industrial primacy waned. London acted as the world's primary capital exporter, funding the rise of the United States. Today, we see US-centric institutions doing the same. Power remains in a currency even as capital migrates. History rhymes. In the late 19th century, British investors allocated massive sums to overseas railways, mines, and sovereign bonds. London acted as the world's primary capital exporter, even as Britain's industrial primacy began to wane. This capital flow preceded and funded the rise of the United States. Today, we see US-centric institutions doing the same, allocating the savings of a mature empire toward the next generation of global growth hubs. Financial power can remain centered in a currency even as capital migrates. After World War II, the US emerged as the dominant provider of global capital, with the dollar at the heart of the world. But today's landscape is more complex. With deep capital markets in Europe and Asia and the expansion of sovereign wealth funds, the unipolar safe haven is giving way to a multipolar financial system. Current reallocations look more like a rebalancing within a dollar-centric system rather than a wholesale regime shift, but the trend is clear. Capital is looking for stability beyond any single flag. This transition to a multipolar system doesn't mean the dollar is dead. It means it is no longer the only game in town. Institutional rebalancing reflects a worldview where risk is dispersed. Capital is migrating to where balance sheets are cleaner and growth is structurally supported. In a multipolar system, influence shifts toward those who control the real assets and the data platforms that manage them. BlackRock is positioning itself at the center of this new, fragmented architecture. Strategy for the new era. For the ordinary investor, the lesson is clear. Excessive home bias is now a systemic risk. Concentration in the Magnificent Seven has been a goldmine, but it has increased your vulnerability to a single market shock. You don't need to mirror every BlackRock move, but you must respect the logic of their diversification. Logic is your only protection. For the ordinary investor, the lesson is clear. Excessive home bias is now a systemic risk. Concentration in the Magnificent Seven has been a goldmine, but it has increased your vulnerability to a single market shock. You don't need to mirror every BlackRock move, but you must respect the logic of their diversification. Consider complementary exposures, equal weight indices or international equities that reduce your dependence on a narrow set of mega-cap winners. Diversification is the only free lunch in finance. Finally, recognize the growing role of real assets. As governments struggle with debt and fiscal sustainability, the private ownership of infrastructure will provide the inflation-linked, contractual cash flows that public bonds once offered. We are moving into an era where capital doesn't look for safety in a flag. It looks for logic in the balance sheet. In a world of higher rates and heavier debt, the physical world is the new safe haven. Build your portfolio with the logic of capital, not the loyalty of the past. Capital doesn't have loyalty, it has logic. If you found this financial intelligence briefing valuable, subscribe to Voice on Pages for more decoding of global power. Check the link in the description to support the channel. I'm Steve. Until next time.